Hi, my name is Darren Joseph from HEG.tax. We're the team that seeks to demystify the sometimes confusing world of international tax. So today we're going to talk about US-Spain tax issues. And to guide us along this interesting road, we have Ricky. Ricky, please introduce yourself.
Well, my name is Ricky Gutierrez. I'm a tax advisor at Gutierrez Pujas and Partners. It's a tax firm located in Barcelona, Spain. I've had international experience for almost 20 years. I'm here to try to answer most of the questions you guys have in terms of international tax and taxes between US and Spain. And well, I'm just here to help you in anything you guys need.
Fantastic. What about channeling US source investment income through a Cyprus or Malta structure? Have you seen that, and what are your thoughts on it?
Obviously, we're focused on international clients. We work with many jurisdictions in the US and in Asia. We've worked quite a lot with Malta, obviously, because it's an attractive jurisdiction in terms of taxation. The thing with Malta and Cyprus, these two types of jurisdictions, they are very common with people that work with trust in the US because their laws are mainly focused on Anglo-Saxon jurisdictions. So these types of jurisdictions, they do recognize these type of figures that are used in the US. So for example, people that are coming to us with trust, whenever they come to Spain, it's a figure that we need to liquidate, recommend these types of jurisdictions. For example, having a trust, then a Cyprus company or a Maltese company, and then, for example, a company in Spain. With this, we would be able to operate. But having a trust and then a Spanish company or Spanish individual, it's something that we never recommend because it's a figure that in Spain, it's not recognizable in Spain or in Italy or in France. It's something that we don't recognize. But yeah, we've seen them quite a lot. Cyprus corporate tax is 12.5. Malta is 35%, but you can get a tax rate of 30% of what you pay. So in the end, the effective tax rate is only 5%. The only thing I need to tell about these two jurisdictions is that laws are changing. So it's a good thing, a good advisor and a good partner there. This person is able to guide you with all these things.
Yeah, absolutely. The changing tax landscape. I always tell clients that your structure is like having a car. It needs to be checked out every so often to make sure that it's going to work. Otherwise, it'll break down on you. And when it comes to Malta especially, you have the emerging idea of the principal purpose test. So if the principal purpose of a structure is to legally avoid or to reduce taxes, tax authorities are increasingly setting it aside because the principal purpose must be commercial in nature. The tax benefit must be incidental, especially where that Malta structure has no economic substance, i.e. it's just a shell company. There are no boots on the ground. You don't have a proper office or there are no investment decisions because we see people using that to channel passive income. Because within the EU, obviously, it could come to Spain tax-free. And it's only going to be taxed at 5% in Malta. So if there's no substance, and if the principal purpose of that structure really is tax, and there's no real commercial benefit, don't be surprised if the tax office says, let's take a deeper look at this.
The main issue they'll have is obviously with opening a bank account. Because obviously banks are very, very reluctant to open accounts with companies that are not going to have any activity in the country just for tax purposes. You're not going to be able to open a bank account. Nowadays, it's even more difficult to open a bank account than just to incorporate a company. International tax substance is the main thing that they are in every country.
I keep telling clients if something sounds too good to be true, probably is too good to be true. So be cautious.